Hi, welcome to Let's Learn Markets with Arvind Venkat. In the series of weekly podcasts, we'll be covering the major financial markets across the planet, starting right from the basics to the advanced levels. So, without any further ado, let's jump right into the topic of the day. So, what is it with these markets? Why are people always flocking to them? What are the stock exchanges? Why are people going there? Why are people even investing? Why are people trading? What is speculation? What is a boom? People call a recession. 2008 they called it a recession. 2000 they call it a recession. What are them? What is a boom? Don't worry, we'll talk about all them and much more in the first episode of the podcast. Boom, bust and recession. So first, we'll understand what are stocks. Imagine having a company with the ownership stake converted into percentages. See, you have 50% and your brother has 50. So that is no problem. And if you want to sell your stake to someone and he wishes to buy that, your friend wishes to buy that. So that makes perfect sense. Your friend buys your 50% in your brother's company and he becomes the stakeholder or shareholder there. But what if there is no single person to buy that 50%, but there are 5 people who are each willing to buy 10% of your brother's company? In that case, what happens? You divide your share into 5 equal shares. And this is the fundamental behind a share. This is the concept behind an equity share. An equity share is a division. It is a part of the ownership of the company. So when you form a company, the people who form the company or the promoters decide the number of shares and the price of the shares that determine the base introductory value of the company. And as the company grows, as the company starts making money, market forces of demand and supply tend to decide the prices of the shares of the company. Typically, the stock exchanges work as the intermediaries. On one side, you have your companies which are ready to raise funds from the public. And on the other side, you have people who are willing to put their money into the markets and invest in suitable companies. So the stock exchanges serve as the marketplace where the buyers meet the sellers and a transaction takes place. Yay! Yay! We have a transaction. So, what happens in a transaction is that the buyer places a buy order of a particular stock at a particular price on his terminal, and the seller places a similar sell order of a particular stock at a particular price on his terminal. So sometimes these two may not meet each other, but sometimes it does happen that the prices coincide, and when the prices meet, you have a transaction. So when the transaction happens, there are 2 things that immediately happen and that are worth noticing. Number 1 is that the prices of the stock changes to the last transacted price. So if this transaction happens at $10, the price of the stock would change to $10. And if the next transaction is going to happen at $11, the stock's price is going to change to $11. And if the forthcoming transaction is going to happen at $9 or even $8, the stock's price is going to suitably change. So the second important thing is that a trade takes place and the traded quantity of that particular stock is going to increase. The stock exchange terminals show the current bid prices and the ask prices. So what are bid and ask? We'll talk about them. Bid is the price that a buyer is willing to buy for a particular stock, and ask is the price that a seller is willing to accept in return for a particular stock. So a stock exchange terminal is going to display both the bid and ask rates of a particular stock so that the people who are buying or selling can make a meaningful decision on where to price the stock, where to price their orders to buy or sell. The reason that this is done is because stock exchanges work on the principle of matching transactions, matching transaction demands. So if there is no transaction that is going to happen, the basic meaning of the stock exchanges gets flawed, and there is no purpose for the existence of stock exchanges. So here are a couple of things that you must keep in mind. Number one, the stock exchange never runs in a loss. So whether you make a profit or not, the stock exchange always gets a commission from you for matching the trade. And that is like the convenience fee that you pay to a marketplace for having buyers and sellers in a single place, like an aggregator. The second important thing is that individual traders or investors cannot trade in the markets with their own money directly in the exchanges. Instead, we have to go through brokers. These brokers are registered individuals under a regulated stock exchange who buy and sell securities on the client's behalf through the stock exchange. So, the brokers do this in return for a fee or a commission, which is generally called the brokerage. So, brokers working with the stock exchanges make sure that your trades are smooth and are settled perfectly before time. So, in this particular area, you'll be finding several alternatives to choose from. Choosing the right broker for you will be based on your tastes and preferences, on how you plan to trade. If you are a tech-savvy person and you prefer using your mobiles for trading, go for a discount broker. That will be fine for you. For the Indian context, you can take Zerodha, you can use Upstocks, you can use 5 Paisa. All these are wonderful discount brokers who work on a mobile-only presence. But there are full-service brokers like Motilal Oswal, Aditya Birla, who still give you the traditional call and trade facility along with the advisory and mobile app facilities. So if you are a person who wishes to go for convenience at any cost, you can go for these full-service brokers. But again, a lot depends on the facilities that you are going to use, because there is no use in having a facility if you are not going to use it. So enough said about brokers. Let's go into the actual trade. There are a few terms, we call it the trading terminology, that everyone has to understand. The first one is going to be short selling. It is funny. If I give you a bag of tomatoes and ask you to sell it, you'll be able to sell it because you have a bag of tomatoes to sell. But in the markets, we come across short selling, where even without a bag of tomatoes, you'll be able to still sell a bag of tomatoes. So how is this possible? See, generally, in India, we follow a T+2 system of settlement. That is, if the transaction is going to happen today, the settlement of the shares transferring from my account to your account will be happening only on the second day after the transaction day. That is T+2. So, if I'm going to sell a share without even owning that is not going to impact my settlement. If I buy that share again before the market closes the same day, because at the end of the day, I'll still be having a net position of 0 shares in that particular company. For example, if I'm going to short sell Reliance, 100 shares of Reliance Industries Limited, and if I'm going to cover them, meaning if I'm going to buy them back before the market closes at 3:30 p.m. Markets open from 9:15 and close at 3:30. So if I'm going to buy them back before 3:30, after the market closes, when the net positions are taken for settlement, no one is going to know. So there you have the concept of short selling. You sell a share and then you buy that particular share a minimum of the same number. That is, if I'm going to sell 100 shares of Reliance, I cannot have a negative position in my portfolio. So if I'm going to sell 100 shares of Reliance, I have to buy a minimum of 100 shares before the market closes at any rate. Whatever be the rate, I have to buy that. If I don't buy that, my broker will automatically buy that for me and will debit my account for that again. That happens. So this is the magic of short selling, and this is the reason on why people make money even in a falling market. Many people just say, be it a rising market or falling market, As long as there is movement, I'm going to make money. And that is how a trader makes money. If a market is going to rise, he'll buy low and sell high. If a market is going to fall, he'll sell high and then buy low. And that is the way to make evergreen profits. We also call it the holy two lines of trading. Buy low, sell high. If it is not possible, sell high, buy low. So moving on to the next important thing in the trading terminologies. And this one is going to be a very, very famous one. Intraday. People call it intraday trading. So to understand this, we'll need to understand what is margin, what is leverage. So leverage is basically getting a debt to finance your purchase of an asset. So that is the principle behind margin. So we call it margin financing, which means if I have 1,000 rupees and a share of say A Limited is priced at 1,000 rupees, I'll be able to buy only one share, right? And that makes sense because I have 1,000, the share is priced at 1,000 and I buy one share. But as if I'm going to, again applying the same logic as in short selling, if I'm going to sell it back before the market closes at 3:30, why can't I buy more? Can my broker lend me money to buy that? And that was the origin behind the margin, the concept of margin. So margin trading or leverage trading is the broker lending you money on a short term and on an extremely short term basis to finance your purchase of the equity share. And this is generally offered by brokers on an intraday basis, which means if I'm going to sell the shares that I bought today morning before 3:30 p.m., brokers will be willing to extend me this. So to be on the safer side, many brokers tend to prefer a closure at 3:15 p.m. So if you have bought a share using margin and if you don't sell it before 3:15, your broker will automatically sell it at 3:15. Just so that you don't cheat the broker. And the remaining amount will be credited to your account after deducting for the broker's brokerage and other charges. So the magic behind margin trading is that if I have 1,000 rupees and the share of A Limited is priced at again 1,000, I'll be able to buy one share without using any kind of leverage, right? And if the price of the share rises by 1% in a day, I'll be getting a profit of 10 rupees. Extremely nominal. But 10 rupees isn't enough. You won't get a cup of coffee with that. So what I do is that I'll use leverage of 10 times. So my broker will lend me 9,000 rupees in my account to buy the shares of A Limited. So instead of buying one share of A Limited, I tend to buy 10 shares of A Limited using the extra margin, extra leverage that the broker has given me. So with this extra money, I get the same 1% increase in the price of A Limited. So this time I'll be having a profit of 100 rupees. And after the broker's brokerage and other charges and taxes, I'll still be having a profit of 88 rupees. And that compared to the normal 10 rupees, you get 10 rupees is pre-tax without any taxes. 88 versus 10, and you have a huge difference. And this is the reason why people prefer margin trading. But one thing that you have to keep in your mind is that the exact opposite situation can also happen. In the worst case, in a situation that the market is not going to go according to your prediction, you predict 2% increase in the prices, but the market falls by same 2%. Without margin, I'll be only losing 2%. But in the same situation, with a margin of 10 times, I'll be losing 20% of my investment. Normally, I'd be losing 20 rupees for an investment of 1,000 rupees. But with a leverage of 10 times, my investment would be amplified to 10,000 rupees and apply 2% on that, you get 200. I'll be losing 200 out of my 1,000 rupees of investment, which comes to 20% of the my investment, is under loss. And after this, your broker would be charging you brokerages and all other taxes and charges. So effectively, you'd be left with only 780 rupees out of your 1000 rupees. Had you not used leverage, you'd still be left with 975 rupees or even more. Even after the brokerage and all the charges are gone. That is the positivity and the negativeness behind the use of margin in trading. As a personal policy and a principle, I say no to two things: average and leverage. We'll talk about average later. So for now, I say no to leverage, because leverage has destroyed more people than it has built. See, no matter what, everyone has to remember this. No matter what, your broker is always going to make profit. Your broker is always going to be profitable. The stock exchanges are always going to be profitable. It is only between us, it is only between the investors and the traders is that the money is revolving. So one person's profit would be another person's loss, and vice versa. This is applicable for trading and not for investing, because in long-term investing, everyone can be profitable at the same time. It doesn't matter. The quantum of profit doesn't matter. It is just that everyone can be profitable at the same time. A boom, a bust, a recession, a depression. All these are four radically different ideas expressing the mood of the markets. A boom is when the markets are steadily increasing, as you might have guessed by the name. A bust is when a steadily increasing market gets snapped down. We also call it a correction because it is not a downtrend, but it is a small setback on an uptrend. And that is in fact healthy, because if you are just increasing without falling down, you're not going to be strong enough. There has been no person who has ever learned to ride a bicycle without falling down. It is the same thing that applies to the markets. So without it falling down, the next rise will not be strong enough. So that is a bust. And the next one is going to be a recession. A recession is when, for an extended period of time, the stock markets spiral downwards. It is the exact opposite of a boom. In a recession, we'll be seeing a good level of unemployment, high levels of inflation, high interest rates to combat that inflation, and hugely negative returns in the stock market. Negative returns of up to 50 to 60% in the stock market. There have been days when about 47% of the stock market was wiped out in a single trading session. There has been days. In fact, the Black Monday was a similar day. Please Google on that. That is a good read. So when it comes to a depression is when the entire stock market collapses. Banks fail. Several banks fail. The entire economic system of a country collapses. The currency stability is jeopardized. The inflation skyrockets, like what happened in Zimbabwe, when the inflation had a high of 45,000% per annum. It rose at 45,000% per annum. Imagine that. Now that is an onset of a depression. And typically a depression lasts for up to 8 years. It takes about 8 years for the economy to slightly wriggle out of the negative spiraling market, of the negative sentiment. So generally depressions, hugely high depressions, hit the markets once in every 80 years. It hit it in 1920, again in 2000, and the next. We'll see it. When it comes, we'll face it. We always have to face the reality. So this is the difference between a boom, a bust, a recession, and a depression. Fortunately, the good thing is that generally booms are always higher, they have a steeper rise, and they always last longer than a bust or a recession. So thankfully, in the long run, all the markets tend to give you positive returns. So if your portfolio is going in losses, but still you have a good stock, or if your markets are going into losses, the entire market is negative, your entire markets are bleeding, Indian markets are bleeding. At that time, buying a share is not a bad idea, because you have shares that can be bought at extremely low prices. Considering that is a good idea. So do your analysis, see if a stock is worth it, and then you can just jump in and buy that stock. Just don't waste your time. MRF, for example, the tire company, was trading at 1,700 in 2008 at the time of the crisis. And after that, in 2017, near the end of 2017, in a span of less than 10 years, it went up from 1,700 to 70,000 plus, 70. And I'm not talking about dividends here. Without taking into consideration any dividends, a shareholder gets such humongous returns on investment. So buying a share during recession is not a bad idea. Again, similarly, selling a share during a boom is not a bad idea either. Because, as Warren Buffett says, and this is my favorite quote, be greedy when all others are afraid, and afraid when all others are greedy. When all the markets are going to rise, everyone is going to be greedy and everyone is going to buy. So at that time, you are supposed to sell and make a good profit at that high price. And when everyone is afraid to buy, take the risk, plunge in and buy and sit tight. Definitely your day will come and your stock will rise. At that time, again, that will be a boom. All people will be greedy and you have to be afraid and exit. So this simple strategy sums up the entire investment, the entire activity behind investment of buying low and selling high, waiting for the perfect time to enter, waiting for the perfect time to exit. Everything is summed up in these two wonderful lines. Be afraid when everyone else is greedy, and be greedy when everyone else is afraid. So, when it comes to stock exchanges, as far as India is concerned, we have two main stock exchanges. The Bombay Stock Exchange, which is the Asia's oldest stock exchange and the world's fastest stock exchange. And we have the National Stock Exchange. Though BSE is the world's fastest and Asia's oldest, still a maximum chunk of volume traded is on the NSE because of its modernness and because of its contemporary nature and standing that it enjoys over the BSE. The BSE has a marquee index called the Sensex. We'll be talking about indices in our next podcast. So for now, I'll just give you an introduction of what the BSE is and what it does. BSE has about 6,000 odd shares listed on it, and NSE has about 2,000 odd shares listed on it. It doesn't mean that BSE is better than NSE, because all the major stocks that you can think of are listed on both BSE and NSE. But some stocks, some small stocks, tend to be listed only on BSE because of the relatively lower costs there. So now, with this level of knowledge, try reading some newspapers, try reading some finance articles which come on Economic Times, the Business Standard, Money Control, Economist, Investopedia. Try reading business newspapers, try reading finance newspapers, read finance articles, and try to understand what they are trying to communicate to you. You'll be slowly able to appreciate the depth of the subject, and you'll be able to understand the meanings of what they are saying. And slowly but surely, you'll be learning how to earn. And that is the reason why we all trade. We all want to earn. But merely emphasizing the earning part is not going to improve us as traders. Because as traders, you're supposed to learn every day and embrace the fact that earn is a part of the bigger process called learn. So embrace this fact, learn every day, be an absolute beginner every day, and move ahead in your life. So that's it for today, and we'll meet you soon in the next episode of the podcast. Let's Learn Markets with Arvind Venkat. Thank you for joining us.